In this video, I'm going to walk through phase 2 in detail, but I really recommend you watching all the videos 1, 2, 3, and 4. And better than that, I really recommend you reading the lectures for phase 1, 2, 3, and 4. The reason I say that is because in those lectures, I'm going to talk about things to help you understand the videos and the concept and the ideas behind this. Because my way of thinking is a lot different than the norm, I promise. So, a lot of people have this concept with retirement. They think of an age, or they think of getting old, or just living your life and doing everything day to day, and then one day you get old enough and you just retire. Well, reality check, that's not really how it works. So there's a lot of people that get older and don't have enough money to make their ends meet. And there's some people that think they pay off all their debt and they get older and they can live fine. None of those things are necessarily true. So retirement is not an age thing. It is a money thing. Yes, they have a full retirement age for Social Security and things like that here in the U.S. But again, if you think Social Security is going to pay for all your bills, then you're going to have to be really, really frugal or something. But if you want to go enjoy yourself where you still got your health span, pay attention, because my wife and I are doing early retirement and living and enjoying our life. So in phase 2, you kind of need to know what you're aiming for. Then you need to know how to get there. And inside of my lectures, I talk about time risk and volatility risk. There is no free lunch. So we'll talk about the assets and different things you can invest in or consider and realize your real expectations to get to those goals. So I'm going to hit on some things I wish I'd known years ago that you should think about before we start getting into crunching numbers and showing you some tools and some things. First off, here in the United States, for us and most people, when you read about it, retiring young, which means anything really before 65, before you can get access to Medicare, is health insurance. Health insurance is a very big burden, very big cost. There are several ways to tackle that, but also on top of the medical insurance, one, the laws can change every year, so you don't know about subsidies, how much it's going to cost, etc. There's also something called Medicaid expansion states. What I mean by Medicaid expansion states, inside the United States, there's 50 states, obviously, then we have territories. But of this Medicaid expansion, when I looked on it a couple months ago when I was doing some research for our early retirement, there's Washington, D.C., the District of Columbia is included, okay? So of the states, there's 40 states that have Medicaid expansion. The last I looked, again, these things can change every year, so do your research on whatever state or territory you live in. So basically what I'm trying to explain is a lot of these videos, I've not seen one yet to talk about what I'm about to say. A lot of these videos talk about the Affordable Care Act, and they go on there and they show you some numbers, and they say if you make over a certain amount of money, you'll have to pay more because you don't get subsidies. That is true, but they're missing out on a very, very big critical part here. There are states, there's 10 of them, that do not have Medicaid expansion. What that means is, like for example, the last I looked on the numbers for us, if our adjusted gross income for my wife and I is under $25,000, we have to pay the same amount of money, which is a lot, for our medical coverage, just as much if we was making $86,000 or more a year. So basically, in a non-Medicaid expansion state, there's a sweet spot. So basically, somewhere around 25 or so thousand to 85,000, and if you stick around 40,000, it's really good. It goes off of the federal poverty level. Okay, so basically, if we can show on paper that our adjusted gross income is somewhere between that range, that we'll pay, we'll still pay, it's still not cheap, but we'll pay a lower premium and cost for our medical coverage, versus if we show we made less than 25,000 or whatever the number is, or more than 85. So basically, what I'm saying is, if we made $10,000 a year, or if we made $200,000 a year, we got to pay the same for our medical coverage. But if you go and you live in a Medicaid expansion state and you make the lower range, then you should have access to that state's Medicaid system for that expansion gap. There are some states that's better than others. And the last I looked, I think Virginia was about the better state. But where I'm at, again, we don't. So we got to play this funny math. So the reason I'm bringing this up is because if you're wanting to walk away and have freedom to do whatever you want before you're 65 years old to get Medicare, you really need to think about medical coverage. Now, I will want to hit on this. I don't want to make a long video on healthcare right here, but I do want to make sure you understand this, because when you're building up your portfolio, you need to know what your target is. In order to make that target, you kind of need to know most variables. And healthcare is a huge variable. And there's an importance for this I'm showing you. So like my wife suggested, because some people online talk about, well, I'm healthy, I just won't cover anything, I'll just pay out of pocket if I go to a doctor, if I get sick or get the sniffles or flu. Wonderful. That is awesome. But here's the problem with that, like I explained to her. I have car insurance on our vehicles and we have homeowners insurance on our homes. Because if something bad happens, it's a just in case, okay? So if I just try to pay out of pocket, what happens if I have to go to surgery for a hernia? Because I'm going through recovery for that right now. What happens when something may happen and I need a disc replacement? 2 years ago, I had a neck disc replaced in my neck. What happens if I have a stroke or a heat stroke or get injured hiking really bad or get in a bad car wreck and I'm in the hospital for a couple of days? Those incidents could bankrupt us. They really could. They could cause us to go to bankruptcy and making payments for medical for the rest of our life. So that's why I say it's important for us to have some form of a just in case medical coverage. Now, people talk about living outside the country and getting international health care. The last I looked, it really isn't much difference for me to live somewhere else and pay for that medical coverage versus us living right here and traveling from where we live. It's actually cheaper for our bills to live where we live now and travel and do whatever we want than it is for us to go travel around the world and live somewhere else outside of the United States. It really is. So anyway, the reason for that is at one point when you're saving up, you're investing and you're growing your money, you need to decide what kind of accounts you want. Do you want it to be in a Roth account? Now, if you read my lectures, you know what I'm talking about. Do you want it to be in a traditional IRA or Roth account? The reason I say that is because if you're of the age to draw money from your Roth accounts without penalties, then you could have millions of dollars on there and living on $100,000 a year, and you can look broke on paper because you're not paying taxes. Well, that's wonderful for certain things, but again, if you're showing no income, no just gross income, and you got to pay your own health insurance in a state without Medicaid expansion, then you're going to have to pay a lot more for your health insurance than you would in these other states. That's why I'm bringing that up right now, because you need to decide what state your home address is going to be, what laws may change in the future, and then what accounts you need to put some of this money into. If you put it in a 401k and it goes into a traditional IRA style and you do a rollover, then you can do what we may have to do if we need to, is you have that funds there and you can do a Roth conversion, and you can do that towards the end of the year when you know exactly what kind of money you want to show for adjusted gross income, and you can play and do a Roth conversion to show a taxable event. If those taxes you'll pay will put your money into a Roth account, and the taxes will be cheaper than what you would have to pay for your health care versus the other subsidies you get. I know it's a lot to digest and think about. Trust me, I know. But these things are extremely important to know when you're building up your portfolio, because you may have a portfolio that's big and retiring and look back at it like I did and be like, dang, I wish I knew these things 10 years ago. I could have changed what accounts I'm in. A Roth IRA is not always the golden egg because it depends on where you live and your health care. It's a great thing, but because if you worry about paying taxes on somebody's Social Security or your Medicare premiums later, then you maybe want it all in a Roth because your income shows low. Anyhow, that's a lot, but you need to know these things. So let's get into the different types of assets that you can consider, and we'll show the risk in the free lunch or not free lunch on these, and then we'll talk about 401ks and then not doing a 401k or doing both. If you read the lectures, you know some of what I'm about to talk about right here. But on these assets, I did not put in a compounding growth rate necessarily on all these things. So I personally like to buy the broad market index funds, ETFs, instead of single individual companies when I'm building up our retirement, our freedom portfolio, because that gives me exposure to the whole market instead of trying to pick one winner or having something just dump on me and mess up my plans, but I'm very close to getting to our goal. When you're looking at the overall market, S&P 500 historical since inception is estimated around 10% compound annual growth rate. And if you're planning this in the tools I'm about to show you, or any tools ever, you can sandbag or, go low on your estimates for compound annual growth rate, because me personally, I'd rather aim at something a little bit lower than historical, and then if I get there sooner, wonderful. But if I plan and expect a higher compound annual growth rate, and then I don't put in as much money or do what I need to hit that goal, then it may take me a lot longer than I wanted to, and I don't want to do that. So of these, we've got S&P 500 and NASDAQ 100. I am a NASDAQ fan. And since inception, now the S&P 500 has been around, or the S&P has been around a lot longer than the NASDAQ 100. And we'll hit on that in a minute. So historical, since inception of NASDAQ 100, is compounded around 13 to 14% a year. And the SSO, which is the leveraged ETFs, 2 times on the S&P since inception, has been around 15 to 18%. QLD, which is 2 times leveraged on the NASDAQ 100, has been around 25%. And UPRO, which is 3 times leveraged on S&P 500, has been around 20% plus. And TQQ, which is 3 times on the NASDAQ 100, has been around 43%. Let me put these things in perspective real quick. Now, these are the sandbag numbers. TQQ and UPRO and all of them have been around since like 2010. QLD, SSO came around like 2006. And I'm going to show you on a chart what I'm referring to, because these are Goldilocks numbers. Unfortunately, there's a lot of people in the market now that hasn't been around a long time or doesn't study history and expect these huge returns to come and go and be great. These numbers are not going to be realistic long term. I'm just going to tell you that right now. I do not see that happening for another 30 years straight. It's just crazy. If it does, wonderful. We'll make fortunes. But I don't want to plan on that. So when I'm putting in my numbers that I'll show you for like QLD and SSO for dollar cost averaging, I would be somewhere around these targets, maybe in 16% for QLD, but definitely not higher than that. I want to jump over here to TradingView on these charts to show you some things, to put things in perspective so you can understand this volatility and time risk thing I'm referring to. On TradingView, I always make sure a chart like this is on logarithmic. Now this is the S&P chart. This is weekly candles. These candles, that's not what's important right here. I want to show you this time frame. If you look at this price action from 2000 all the way over here to 2013, that is what people call a lost decade. But for people in phase 2, and again, I will get to a tool to show you how long phase 2 lasts depending on the size of your portfolio and your time frame, and then get into phase 3 and 4. But when you're in phase 2 and you're learning your accounts and how to invest your money and do whatever you decide to do to build it up, you should want these kind of things to happen. Now I know it sounds contradictory because everybody buys stuff and when it goes down they freak out and want to sell. Well, if you're in phase 2, your account is small anyway and you're dollar cost averaging, which means you're putting your money in and buying whatever it is you decide, whatever ETF you decide to buy, you're buying it on schedule, that same amount, until that portfolio grows and big enough to when you need to protect it at that point, which should be phase 3. And then when it gets big enough in phase 4, it replaces your job. But right now in phase 2, I'm making you aware these things can last 10 years, 13 years. But if you're averaging, you'll be averaging in and you'll be getting a price, and your basket, your money of shares will be getting bigger and bigger and bigger. And then when it takes up for another bull cycle going up, you'll be in a great shape. If you're starting out here, you cannot predict the time, the sequence of events, neither can I. But if you was going through here, through this late 80s through 90s boom, you may feel good because you're like, oh, I just bought so-and-so last year, I got $5,000 in it and it's went up. That's the wrong way, because when it comes to something like this, you could be on the tail end of it. It's still survivable and it's still good. But let's say you started in the mid 90s and you get all the way up here, and in your portfolio you've been building up for 5 years, and let's say you got $50,000 or $100,000 in it and it drops 50%, you're gonna be freaked out and hopefully you don't sell it. But instead, that's why I preach on volatility and time risk and stuff like that. you should get in here and get your mindset right and dollar cost averaging in here in a broad market index. Again, do whatever you decide to do, and then you keep buying in until it hits to that target that you'll need that I'm gonna cover in a minute. And then you'll just your portfolio continues to grow. So as far as what the market does, from my math and my opinions of what I'm trying to say is, now individual stocks is a whole different ballgame, but the broad market index, if you're doing a NASDAQ 100 or the S&P, like with QLD or SSO, read those articles on those pages. That's why I don't want to say that here. Read the articles that's linked on those pages where I will speak on leverage ETFs, and you can see the math in the articles and what you need to see to make the decisions you want to do. I would not be dollar cost averaging in anything 3X like TQQQ or UPRO. I use those later, we'll talk about in later videos. But anyhow, so that's what you'd want to be doing. And the reason I'm showing this is because we go through all kind of cycles. We had the whole thing from 1965 through the 70s, and then of course the 1929 big crash. The market goes through cycles, but don't get emotionally attached to it. As long as you got an emergency fund in place and everything's secure in your household, then I would just let that money keep building up. When you're logged in on the website, on our website, there is a bell for notifications right there, and that goes to our community. And there I'll do a lot of updates just to let you know. But when you're logged in, you'll go to, you should see, you should see the quick access buttons, and then whatever you're in, phase 1 or whatever. But if you have the complete systems phases to include all phases, you'll see this. But what I want to show you is, so you know how to use some of these things, so you can see what I'm talking about going forward, is the quick access. You open it up, and this is your friend too with all this stuff right here. We're on the quick access buttons now because you hit quick access. And the quick access buttons, these are the ones for the phase 1 calculators I talked about, and then the advanced strategy tools library. You can go here, and then you'll see a lot of your stuff for your 401ks or your 403b, your tool, and then your financial freedom calculator. There's several things here that work for phase 2, 3, and 4, and you can go through here and play with those to help you understand your target. But for phase 2, the two main ones I want to hit on is your 401k tool. The reason I'm going to talk about 401k is because if you have a 401k at your job, you should be able to choose if you want to put it in a Roth or traditional. Now, whatever the employer puts in for you by law has to go into the traditional side. But whatever you contribute, you should be able to choose you want to put it in a Roth or traditional. Now that's going to determine and matter based on, like I said, with the health insurance later, or do you want a bigger Roth account? Because your Roth with a 401k, you can put in a lot more money than you can just putting in your own Roth IRA. But you're also going to put in, that's going to be tax money. So it depends on your budget, how tight your budget is, your living expenses, and your tax brackets, if it's going to be feasible for you or not. But that's things for you to decide, and I'm bringing that up so you know that. Now, if you decide you want to have more in a taxable account so you can do Roth conversions later, if you need to play the game for your medical coverage, you can put in a lot more in the traditional to have that money there later, so you can do your 401k rollover, then a Roth IRA rollover, a Roth rollover if you want to. But a 401k is good for some and not for others. For me, for example, I don't contribute to my 401k because my employer puts in some money anyway, and money I put in, I only have a few baskets to pick from. It's pretty much a cookie cutter, one that I can't stand. You only get to pick a few choices. Now, if you have a 401k like my wife has, which I absolutely love, with the company she's with, the 401k gets you to choose, if you sign up for it, a self-direct program, which I like because I can take her money in her 401k and I manage it, and I can buy things like QLD or TQQQ to do whatever we need to do with our accounts for what I do. This is more phase 3 thing. But if your 401k has flexibility and you can pretty much buy anything you want, ETF wise you want, you may want to consider that if you want to. So on this tool, you can put in your dates and you can go here and use this tool. I just want to show you real briefly, and you get to choose information, your salaries and employee limit and your dates. But right here with your employer match, I put in some things here. There's several different types of employer matches, and then your investment style and comparison. You can pick a broad market index, target date funds, which I don't like at all, and other things like that. And then in the background, the growth rate is built in what I put in here, but you can also put in your own if you want to. And then you can compare it to the other types of ways and get an idea. These are all estimates because the market is going to move differently with different sequence of events. And then income, which I didn't talk about in phase 2, that's more of a phase 4 thing. That's why I say look in and read those lectures. What you need to understand when your goal, here goes to your goal. If you want whatever X amount of money it is you need to replace your job, whether it's $50,000 or $100,000 a year, whatever it is, you need to figure out that first, and you need to figure out what your portfolio needs to build to replenish that amount of money. Now, if you plan on retiring or be financially free, you can, like we are in our early 50s, we will bridge, that's another topic for phase 3, we bridge our income so we have enough income to get to the point where we can hit our IRAs, and then that money getting to Social Security. But the reason I put the 4% and 6% in here is, and you can look at these, but the reason I put that in there is because when you do research on income, which I hope you do before you start building a portfolio up too big or small, so you know what you need to aim for. If you call financial money managers or look up the 4% rule, most of them will talk about 4%, maybe 5% of income per year. And then I put in here 6% because I think very easily you can get 6% out of your and continue to go if you do what we're doing with our growth side on phase 3 and 4. Now, if you're asking if the market normally goes up 10% or whatever, why 4% or 6%? That's a good question. It's a fair question. Because compound annual growth rate is a measurement over a certain amount of time to smooth out a ramp. However, in the real world, there's a sequence of events like I showed you those last decades. If the market's dropping 20 and 30%, and I know people talk about annual returns of the market, which I think is one of the most dangerous things people should put out there and put their money, invest their future on that. Because the market does go up most years, but if this went down 20% or 30%, it's going to take that year or a year and a half or two that went down, and then it's going to take another year or two or whatever to get back up. So that's a U or a V, and it takes time to get back up to that point. Well, you need groceries every month. So when you got to buy your bills and you're selling it at a lower price, that's called a sequence of event or a sequence of returns, which could cause, that will change the amount you can pull out. You're not just dollar cost averaging anymore in retirement. So in phase 2, you're dollar cost averaging, but you need to know where you're going to aim for. So if you want a 4% return or 6% return, then you need to see how much you need. So you go to calculate your estimates, and you can change this to get an idea. You don't need everything to be the 401k. You can do some money in 401k and some money invest in your own portfolio to get to what you need to do. Because if you're younger or you have a lot more money to get there, you may be like, hey, I want my money sooner, so I'll do it on my own. But know this, if you work for a company and you got a 401k and you quit your job or retire and separate from this, you can contact that whomever has your 401k, whatever company it is, and your brokerage account, your people at your brokerage firm, and then you can transition that money to a 401k rollover, and then you can have access and do with it however you need to. But if it's in an IRA, it would be an IRA, so you need to be 59.5 without penalty. Unless you're the rule of 55, which I talked about in our lectures. Not getting the rule of 55 here though. So this gives you an idea. And the reason I built this tool is so you can go on here, put in your numbers, how much you want to do, what the company does or whatever, and then you can track this and see, and gives you an idea of like, hey, maybe I need to put in more or I need to put in less. And you can help you make a decision to see what your target is. Because if the market rolls over, and it always does at some point, and it's down 1 year, you may want to consider buying more stuff if you can afford to, or adjust likewise. So that's the point of this tool. It gives you a visual, and more importantly, the red line right there, and then right here, your total contributions. Because a lot of people say, oh, you need to save up to $1 million or whatever. You pick a number. Well, that's not necessarily saving. I hate that word. You need to compound and grow your money, because your contributions here in this case was only $90,000, but your estimated ending balance is $528,000. So you only put in $90,000 and grew to $528 in this time period, and your employer put in $60,000. So your $90,000 plus your $60,000, $150,000 went in there, and it grew to $528,000. That is the power of the market compounding. And I know the first couple of years when you're starting out, it seems like you're stuck in mud. It really will. But eventually, when your portfolio goes from a couple $100 to a couple $1,000, you start getting over $10,000, and then when you hit that $100,000 mark, you'll start to see some bigger gains. And if you ever put in long enough and grow big enough, and you hit that $1 million mark, you'll be amazed at how much it'll move. And then things change a lot faster. Now, you may be wondering how long you need to stay in phase 2 to go to phase 3 or 4. That's what you need to know. You need to know what you're aiming for. So at some point, your portfolio is going to grow big enough to where it's more important to protect that growth than get caught up into a lost decade. Because if you go through, like I showed you on that chart, and your portfolio gets significantly large, and then you go to a 30% or 50% pull down, and it takes you several years to get back up where you are, it can throw your financial freedom goals, your retirement, your early retirement out of whack by a couple of years or longer. So at some point, that portfolio gets big enough to where you need to worry about a sequence of returns. But at the beginning, when you're building it up, that's kind of irrelevant. But how big does it need to be concerned about it? Well, I'm going to show you. I know the answer, but let me show you on here so you don't get overwhelmed if I just say a number. So you put in your information here on this financial freedom calculator, and you can use different currencies depending on where you're at in the world. So you can put your monthly lifestyle cost today, whatever number that is. Right now it says default 4,000. Inflation, you can change that however you want to. Other annual income. This is important because if you're older, or you think you will be older when this happens, and your other income will be a pension or Social Security or what have you, you can put those in, because that's going to change how much money your portfolio needs. See, that's what people need to understand. If you can add this with the other income, so you don't have to work until you're 80 years old or never get to your goal. And then when you change those numbers, and you can just go down here to the projections, and you put in your annual increase if you want to, your starting investing balance, contribution, dollar cost average, and then you can put in your birth date. And I don't know your birth date obviously, but we'll just put in somebody young, January 1st, 2000, and you can run the roadmap, and then you can see if you even hit your goals. So what I have on here is phase 3, 4, and then I have 3 4s as well, but it's phase 3 and then it's phase 4, 4, and 4, because this is for different life support, because you need to decide if you're a person who likes time risk, volatility risk, or something that's less volatile. That's the point of these different funds I was talking about, is because if you're somebody that gets emotional of the movements, the volatility, you need to be more conservative, you need more money to get to your goal. So if you're, depending on how much you put in, you can put in and change this to where you'll get. But the point being is your phase 3s will come a lot sooner than phase 4 if you keep doing this. And again, the compound growth rate is a smooth line. But the red line at the bottom looks so small because that is your total amount invested. And you can see the power or growth of how much your money will grow with compounding versus just you sticking it in a CD or a high yield savings account or what have you. That stuff is for an emergency fund. This here is to grow your money. And your compound annual growth rate assumption right here on my computer, it may have just saved in my computer, is at 10%. Now, if you want to go 16, like say you do this QLD, and you want to see, you'll see how quick it can change and how much it can grow. You play with that number, but be realistic, okay? don't assume it's always going to be 20 or what have you. You can put in 10, 12, 16, whatever you decide. But just to give you an idea of about where you would get to at that time. And this shows you how much you put in and how much it grew and so forth. Now, to answer this question, right now I have it figured out on about 5x. About 5x. Now, it's with inflation, you can change that. What I mean is, and again, I want you to understand, I have to explain this and I want people to understand. So, right here, your contributions, right here on this yellow dot, right here, this yellow dot, your contributions by them were estimated $74,378. So that's how much money you put in. It grew to $360,729. So what I'm saying is, when I say you need to save up to 5x or grow to 5x, like if you needed $100,000 a year, I don't mean you need to wait till you save up $500,000, because you would probably be never getting there. What you need to do is grow to $500,000. The more you put in, with depending on what asset and compounded growth rates you go expect it to get, the faster you go get there. With the larger compounded growth rates, are going to be with those leveraged 2x ETFs, and there's going to be a lot more volatility, meaning up and down. That's why it's super important to look at my phase 3 and consider doing stuff like that to protect that, because you don't want something going down 73% and taking 2 years to get back up to where you were, and then putting everything you want on hold. But on basic, in a real environment, a real good market environment, you're looking at 5x for simple numbers. Now, if we're in a market that's going to be kind of troublesome and volatile and not as great, you want to go for maybe 8x and go a little past this. So the reason I say that, and you're like, well, how would I know that? Well, I'm going to show you. So this is like a good case. You can start looking at it going to phase 3, and then if you want to go a little more money than that and let it keep growing, because I'm going to show you right here on the chart. All right, not trying to overcomplicate things, but when your portfolio gets a little larger, you can look at some things. But what I want to show you is the 1960s and 1970s, when the market was doing this right here. This is the worst time in history to do something like phase 3 that I'm in. But so dollar cost averaging right here, and it's letting it ride up and down like here. If you have time and you not need the money within like 5 years or something like that, then it's in that situation, it's just best to dollar cost average and ride it out until you get to your goal and keep adding money. In most cases, the .com crash and everything like this, same scenario. Now, it's easy to look back in hindsight and say that. So you're sitting there going, how would you know that in real time? It's hard, but here, let me show you some canary in the coal mines, and then you can understand what I'm talking about. I'm not going into a long lecture about bonds, but right now I'm looking at US 10-year bonds. So right here, the ticker symbol US 10Y, the 10-year bond rate. Go to that chart on TradingView and put it on regular. If it doesn't automatically do that, make sure it's on regular. Then you go here, and I want to show you something. Remember, I talked about 1965 and then 2000 and 1970, right? Over here, it's hard to see because it doesn't have the candle. These are weekly, but it doesn't show very good on the chart. Little dotted dots, and it goes back to 1913 or something like that. So if you look right here in 1950s, and these little green dots were going down. It's the direction of the bond yields and direction of stuff, and I'll explain why. So the bonds were going down, and then 1965, there's more to it than just bonds, but you know, you got stagflation, inflation, all this stuff. I'm not getting all that right here on this phase 2 video. But there's always money to be made in the market, and it's important to know where to make money in the market. It becomes very transparent and very fun in phase 4. But in phase 2, you need to know how long to be dollar cost averaging and when it becomes important to protect your capital. So it started in right here, the bond yields started going up in the late 50s, and in the 1970s was that time where bond yields was up over 7%, and then toward 1980 they were in triple digits, and then it peaked out over here around 1981 at 15%. What that means is I could have, or you could have, go out here and buy US 10-year bond, and we can lock in that rate and get paid that amount each year and tie up the money. So that's a lot higher than that 4% or 6% withdrawal. The point being is the money managers out there know that when bond yields, they can go out there in the bond market and they can get bond yields around 5%. It starts looking attractive because you can buy a U.S. Treasury bond around 5% or more. Then it's easier to start setting more capital there with no volatility as far as, unless you let it go to maturity to whenever it expires. You can buy those bonds and you make that money on there versus putting it in a stock market and taking a chance of a crash to manage people's money. It doesn't have to be all the money, but it could be a significant amount, so it pulls money out of the market. And then the money into the market starts going kind of sideways with liquidity. I'm not getting into all that video here, but what I'm saying is it's very important to look at this. If you see the U.S. Treasury going upward and you're building a portfolio up and you got on that calculator and you're like, okay, I'm almost at a phase 3. If the bond rates are going up and upward trajectory and you don't need this money within like 5 years, it may be best to just keep dollar cost averaging until your portfolio gets even larger, then worry about protecting that money. That is my point. So here's the thing. The bond yields got up really high around 1981. And then the bonds and the bond yields been going down ever since until COVID. Now, what about, let's hit on 2000 era. Now, 2000 was, everything's not just about the bond yield. But in 2000, you had a lot of craziness with the dot-com bubble and people overpaying for companies, and it got parabolic after 1995 through 2000. So those things happened, and then that event happened. Then it just got, the market just got overzealous with the price to earnings multiples, which we can discuss as well on my website. But so anyway, through this time, the yield's around 6%. Just because at 5, like I said, just because it sits at 5 does not mean the market's going to go crazy. But it's the angle or the direction, because it got really low after COVID because the Federal Reserve with central banks and everything had to step in several times through history actually and change the borrowing rate for banks to each other, and then everything kind of works off of that. So there's different years. There's not always a 10-year bond. There's longer time. The short, extremely short bonds, long-term, mid-term, and all that stuff. But U.S. 10 years is good to look at for a indicator or canary in the coal mine. Now the bonds right now have been going sideways lately, but if currently, which the new Fed chair that makes the decisions on the Fed rates, if he starts talking about raising rates one time or multiple times because of this inflation, then things can get a little shaky in the market. That's my point. But all I'm doing is for phase 2 purposes. You can pull up US 10-year, look at the direction of the 10-year bond yields, and then see, hey, look, if we're getting over 5%, or is the Fed chair talking about raising rates, then maybe I want to stay in a little longer. Unless you need that money soon, then you can start thinking about doing phase 3. These are things you need to look at like a canary in the coal mine. On TradingView, you can also pull up ticker symbol, well, it says FEDFUNDS right here, FEDFUNDS, right up there. And this shows you what the federal funds rate is. And then the same thing, you want this on regular. And I put a 5 and a 6 here. This shows you they all work kind of together, okay? The Fed does not change what a U.S. 10-year bond is going to be, and vice versa. The central banks, Fed funds, around the central banks of the world and the central banks change the rates from one. Here, let me put it in a nutshell. The Fed fund raises rates, and that's the borrowing rate from one bank to another. Say if a Bank of America, Wells Fargo, JP Morgan, whatever, they needed to borrow money to pay each other, not what we get, but they had to, and it works with the Fed funds, they change what rate of rates they're going to be getting paid each other. And then they go likewise change rates that people can borrow from, and then it all works together, and then the treasury market. It's all kind of weird linked together. But so you can see right now the Fed funds rates has been dropping since May of 2024 down. This is June 11th, 2026. Next week, the new Fed chairs will start talking again, and we'll see what happens. But that's just how this works in a nutshell. It's been on a downward spiral, and when they get up high, The reason this is important is because there's money to be made in bonds and there's money to be made in equities, stocks. So when your portfolio builds and gets large enough for like phase 4 or bridging from phase 3 to 4, you can start looking at these things to make money as well. Me, for growth, I want this to be going in a downward trend. When this goes down in a downward trend, it's easier for companies to borrow money cheaper to grow and boom and all this growth stuff. It makes it easier to grow your money in the market. But when this starts going up high and getting out of control, trying to control inflation or jobs or whatever, then there's more money to be made in the bond market. That is the whole idea of knowing these things to put in your toolbox along with just the stock market by itself. Because you need to know what kind of environment you're in to know what your target's going to be. All right, let me summarize and conclusion on this phase 2 thing. Phase 2, try not to overwhelm you because it's probably of the 4 phases, it's the easiest phase of all of them. 1, you need to decide, can you handle volatility with your portfolio going up and down and not staring at it, stressing it out, and panicking and selling. 2, if you have an emergency fund in place, steady income coming in from a job or wherever it may be, and your household's under control and what have you from phase 1, then phase 2 is where the fun begins and you can start paying your future self, whether it be 401k or 401k in your own portfolio or just your own portfolio. Now, equities, stocks, to me is the cheapest thing to get into because it only takes a couple dollars or dollar, whatever, buy fractional shares or whatever. It's the cheapest thing to get into with great growth potential. You don't have to worry about saving up a whole lot of money to go buy a rental house and have that one rental house or rental house in that one location exposed to that local economy, wherever that home is, whether it be in the weather and the jobs and everything, and your tenants and your state laws to protect tenants versus landlords. With the stock market, over time, everything usually grows. But I mean, I can't promise you that the United States stock markets could continue to grow, forever. I can't make those promises. But I can say that if you buy a broad market index or something with exposure to it, whether it be the S&P 500 or the NASDAQ 100, those are controlled, and those companies got to meet a certain criteria. And when other companies need to come in to take another one out, or vice versa, or whatever. And those companies have products or services they sell usually around the world. So you have international exposure. And it's not just like trying to pick what one stock or 5 stocks to go buy. You get the broad market index. So the point being is you're just adding in your money. Now when you start getting your money up, like I said, 5 times what you need to replace your job, or 8 times depending on what the U.S. 10-year is doing and the Federal Reserve, then you need to start considering phase 3. Now when you watch the video on phase 3 and 4, you may want to, depending on you, consider doing things in phase 3 now, even though you're just starting. The reason I say that is because I'm going to cover this what I do in phase 3. But let's just say you saved up enough money to put down on a vehicle, just one example of many, or pay for a college kid, or whatever. If you like what I do in phase 3, what I cover, you may want to say, hey, I want to put that money doing that system, and then the money that grows off of that money, then I'll use that to buy the things I want to do, and then I'll have my original capital. No promises, but those are ideas, and those things I'll cover in phase 3. Anyway, I hope you understand what I was talking about in phase 2. It's a long video because it's very, very important, and you need to make the decision if you're comfortable with these leverage ETFs. And again, I highly recommend, I highly do not recommend anything that's more than 2 times leverage ETF for dollar cost averaging purposes. That's just my opinion, and it's based on math. And read those articles that's on that page in my lectures where I talk about QLD and SSO. Read those 2 articles and read what I'm showing you and what I'm sharing with you and how those things work. Because if you buy SSO and QLD, or just QLD, or whatever you decide to do, it might happen, but it will happen. If the market goes down, like a bear market crash 20% or so, those things can go down easily 50% a year. but that's unrealized returns. If you're dollar cost average and you keep buying at a discount price and it's bond market, then they go back up with it over time, then you'll be in a better situation. But again, you got to understand if you're comfortable with that or not and have an emergency fund set aside. That's why I stress time risk versus volatility risk, because time risk is buying something really conservative that's really slow moving. It's going to take you many years to get to that goal. If you buy something that moves aggressively, but it's broad market, it's not individual company, then it's going to take you, mathematically, it should take you a lot less years to get to that point. As long as you protect your portfolio when it gets big enough to be protected in a phase 3, so you're not riding through a terrible time in history. Thank you. Have a good day.